It started with a few words on a screen. Simple, direct, and devastating. Donald Trump announced his intention to impose a crushing 100% tariff on all Chinese goods entering the United States, effective from the first day of November. The declaration arrived without warning, without consultation, and without mercy. Within moments, the global financial system convulsed. Stock exchanges from New York to Tokyo watched in real time as billions of dollars evaporated. The Dow Jones Industrial Average hemorrhaged hundreds of points in mere minutes. Crude oil prices collapsed beneath the $60 threshold for the first time in months. Bitcoin, the digital currency that thrives on chaos, plunged as panic-stricken investors liquidated positions across every asset class imaginable. On trading floors around the world, professionals sat frozen before their terminals, eyes locked on cascading red figures that painted a picture of total uncertainty. It was a scene many had hoped never to witness again, a painful echo of the turbulent trade battles that rattled the global economy back in 2018. The psychological impact was instant and profound. Uncertainty, that invisible force that paralyzes decision-making and freezes capital, returned with a vengeance. Once again, the world was reminded of an uncomfortable truth. A single statement from Washington could send shockwaves through the entire planetary economy. Investors scrambled for safety. Gold prices surged toward historic peaks as money fled from stocks and bonds into the ancient refuge of precious metals. The US dollar, typically a safe haven during crises, stumbled awkwardly as confidence wavered. Across Asia, currencies swung wildly, caught between fear of American protectionism and uncertainty about what would come next. But in Beijing, something remarkable happened. There was no emergency press briefing, no heated rhetoric, no angry official statement rushed to news agencies in the dead of night. Instead, Chinese government officials maintained an almost eerie composure. Behind closed doors, they quietly reinforced their control over something far more valuable than tariffs or trade quotas: rare earth elements, the invisible materials that power everything from smartphones to fighter jets, from wind turbines to guided missiles. Beijing understood something Washington had yet to fully grasp. In modern economic warfare, the most powerful weapon isn't volume, it's leverage. This calm, calculated response stood in stark contrast to the theatrical chaos emanating from the White House. One government seemed obsessed with capturing headlines and projecting dominance. The other appeared focused on long-term strategy and structural advantage. As American markets continued their freefall and oil prices sank deeper, China's measured silence began to transform in the eyes of global observers. What initially might have looked like hesitation or weakness now appeared to be something far more dangerous: control. The stage was being set for yet another confrontation between the world's two largest economies. But this time, the fundamental balance of power looked fundamentally different than it had in previous rounds of this ongoing struggle. Before we dive deeper into this unfolding story, take a moment to subscribe. Your support helps us continue delivering independent, in-depth analysis of the global forces reshaping our world. The announcement arrived with Trump's characteristic blend of boldness and improvisation. Standing before cameras, projecting confidence and determination, he made a promise that would send economic analysts scrambling and corporate executives into emergency planning sessions. Starting on November 1st, he declared, every single product imported from China would face an additional 100% tariff, layered on top of existing duties that already averaged around 30% for many Chinese goods. Let that sink in for a moment. For American companies that import from China, this wasn't just another incremental policy shift. This represented the potential for overnight price explosions. Products that cost $100 could suddenly carry a price tag of $230 or more after all tariffs were applied. The scope was breathtaking. Nearly $470 billion worth of Chinese imports would be affected. Everything from sophisticated electronics and industrial steel to ordinary household items found in every American home. Smartphones, appliances, furniture, toys, clothing, machinery, virtually nothing would escape the impact. Trump framed the decision as an unavoidable response to what he characterized as China's aggressive and hostile economic behavior. He specifically referenced Beijing's recent implementation of new export restrictions on rare earth minerals, those obscure but absolutely critical materials used in advanced manufacturing and cutting-edge technology. According to Trump's narrative, China was attempting to hold the entire world hostage by restricting access to elements essential for electric vehicle motors, precision-guided weapon systems, and semiconductor manufacturing. He portrayed the tariff announcement as a defensive measure, a necessary counterpunch to Chinese economic coercion. Yet the announcement came with conspicuous gaps. There was no detailed policy document, no implementation timeline beyond the basic November 1st date, no evidence of coordination with congressional leaders or international allies, no clear explanation of how enforcement would work or what exemptions might exist. Financial markets interpreted these omissions as signs of something troubling. This appeared to be another impulsive decision, driven more by political theater than by carefully considered economic strategy. It seemed designed to project strength and dominance rather than to actually resolve the underlying trade dispute. Analysts on Bloomberg's morning programming didn't mince words. One veteran trader put it bluntly: the president fires his weapon first and considers the consequences later. This pattern had become familiar to anyone watching Trump's approach to economic policy. Bold proclamations delivered to maximize media coverage, often timed to coincide with political events or to distract from other controversies. Aggressive rhetoric deployed just weeks before the APEC summit, where Trump had been widely expected to hold face-to-face meetings with Chinese President Xi Jinping. Behind the public spectacle, confusion reigned within the bureaucracy. Officials at the United States Trade Representative's office found themselves scrambling to figure out how this new tariff regime would actually be implemented. Business organizations, from the Chamber of Commerce to industry-specific trade groups, issued warnings that the financial burden would fall overwhelmingly on American companies and ultimately on American consumers. Economists rushed to model the potential impact. Their projections painted a sobering picture. Tariffs of this magnitude could shave somewhere between 0.4 and 0.4% off United States GDP growth in 2026. Consumer price inflation, already a political flashpoint, would almost certainly accelerate as import costs surged. While Washington descended into heated debate and partisan finger-pointing, Beijing's response followed an entirely different script. Chinese government ministries avoided direct confrontation. There were no inflammatory counter-threats, no matching escalation of rhetoric. Instead, official statements from Beijing conveyed a different message. We understand that this battle is fundamentally about control and leverage, not about who can generate the most dramatic headlines. This contrast, one side shouting for attention, the other calculating its next moves in silence, would come to define the entire next phase of this escalating standoff between the world's two dominant economic powers. Just days before Trump issued his explosive 100% tariff threat, Beijing had already made its own strategic move. The difference was striking. While Trump's announcement dominated global news cycles, China's action received relatively little attention at first, yet it carried far more substantive weight than any social media outburst ever could. On October 9th, China's Ministry of Commerce published new regulations imposing significantly tighter export controls on rare earth materials and the technologies associated with their production. This wasn't simply another round of tariffs or quotas. This was something far more comprehensive and, honestly, far more consequential. The restrictions covered every single stage of the supply chain, from initial mining operations and refining processes through magnet manufacturing and assembly, all the way to maintenance services and equipment repairs. Any foreign company attempting to work with these materials would now require special licenses. And crucially, approval would depend on demonstrating exactly how those materials would be used and ensuring they wouldn't be diverted toward military applications. In official statements, Beijing characterized the decision as a straightforward matter of national security. The government needed to ensure that sensitive technologies and strategic materials couldn't be redirected toward purposes that might threaten China's interests, particularly military purposes. But, the timing of the announcement sent a message that resonated far beyond bureaucratic language about security protocols. It was a reminder, delivered with surgical precision, that China controls access to resources that the United States and its allies cannot easily or quickly replace. Consider the numbers. China dominates rare earth production with an iron grip. The country controls approximately 70% of global mining operations for these elements. But mining is just the beginning. When it comes to processing these raw materials into usable forms, the complex, expensive, and environmentally challenging refining work, China's dominance becomes even more absolute, accounting for more than 90% of global processing capacity. These aren't obscure materials with limited applications. Rare earth elements are absolutely essential for modern technology. They're found in smartphones that billions of people carry in their pockets. They're critical components in advanced fighter jets and naval vessels. They power wind turbines and renewable energy installations across the globe. They enable the electric motors that are supposed to drive the transition away from fossil fuels. This wasn't a loud gesture designed for television cameras. It was a strategic signal, delivered in the language of policy documents and regulatory frameworks. While Washington threatened economic pain through tariffs, China calmly tightened its grip on the actual materials that power the modern economy. Analysts working in Singapore's financial district and London's investment houses immediately recognized what they were seeing. They called it a surgical strike aimed directly at America's most vulnerable pressure point in the technology supply chain. The announcement sent immediate shockwaves through manufacturing networks across Asia and Europe. Companies that depend on Chinese rare earth components began emergency stockpiling, ordering months' worth of supplies in advance, fearful of what restrictions might come next. Prices for certain rare earth elements jumped by double-digit percentages in just days. For Beijing strategists, this move accomplished multiple objectives simultaneously. First, it demonstrated resolve and seriousness of purpose, without resorting to open confrontation or inflammatory rhetoric that might back either side into a corner. It showed the world that China wasn't going to be pushed around, but it did so through measured policy rather than threats. Second, and perhaps more importantly, it gave China leverage that no tariff could possibly undo. The United States can impose whatever duties it wants on Chinese imports, but that doesn't change the fundamental reality. American technology companies, defense contractors, and manufacturers remain deeply dependent on Chinese-controlled rare earth supply chains. That dependence can't be wished away or tariffed out of existence. It would take years, perhaps decades, and hundreds of billions of dollars in investment to meaningfully shift. As Trump's rhetoric continued to rattle financial markets and unsettle investors, China was demonstrating a fundamental principle of modern economic statecraft. The most powerful weapon in a trade war isn't anger, outrage, or theatrical displays of toughness. It's control. Quiet, structural, undeniable control over resources that others desperately need and cannot easily obtain elsewhere. The reaction from global financial markets was immediate, violent, and comprehensive. Within hours of Trump's tariff threat becoming public, virtually every major asset class was plunging in synchronized panic. The Dow Jones Industrial Average, that historic barometer of American economic confidence, plummeted by nearly 880 points in a single trading session. The S&P 500, representing America's largest corporations, fell 2.7%. The tech-heavy NASDAQ Composite tumbled 3.6%, its sharpest single-day decline since early 2024. Billions upon billions of dollars in market capitalization simply vanished during those frantic hours of trading. Pension funds, retirement accounts, investment portfolios all took massive hits as panic spread through the financial system. The Philadelphia Semiconductor Index, which tracks companies heavily exposed to Chinese manufacturing and markets, suffered particularly brutal punishment, losing more than 6% of its value. Giants like Nvidia and AMD, companies whose entire business models depend on global supply chains and Chinese market access, faced massive waves of selling as investors rushed for the exits. The pain wasn't confined to equity markets. Oil prices followed the same downward spiral, driven by fears that an escalating trade war would choke off economic growth and destroy demand for energy. United States crude oil crashed below the $60 per barrel mark, hitting levels not seen in almost half a year. Brent crude, the international benchmark, slipped to approximately $60.20 per barrel. For commodity traders, these price movements told a clear story. The world's two largest economies were sliding toward another period of slowing growth, reduced consumption, and economic stagnation. Currency markets convulsed as well. The dollar index, which measures the greenback's strength against a basket of major currencies, weakened to 97.6 as confidence in American economic management eroded. Meanwhile, traditional safe haven currencies surged. The Japanese yen and Swiss franc both strengthened sharply as investors sought shelter from the storm. But perhaps the most dramatic panic appeared in cryptocurrency markets, those digital assets that thrive on risk appetite and speculative enthusiasm. When fear takes hold, crypto typically suffers disproportionately, and this moment proved no exception. Over a span of just 24 hours, more than $19 billion in leveraged cryptocurrency positions were liquidated, wiped out by automatic systems designed to prevent even larger losses. Bitcoin, the flagship digital asset, sank 12%. Ethereum dropped 10%. Smaller alternative tokens experienced even more catastrophic collapses, with some losing 20, 30, or even 40% of their value in hours. For a market ecosystem built entirely on risk appetite and speculative confidence, Trump's tariff gamble triggered what many described as a flash crash, a sudden, violent repricing driven by pure fear. Meanwhile, one asset soared amid the carnage. Gold, humanity's oldest store of value, hit a new record high, briefly surging past $4,000 per troy ounce. Capital was fleeing from stocks, bonds, and digital assets straight into the ancient safety of precious metals. Financial analysts described what they were witnessing as a flight from chaos, a rare moment when investors, professional traders, sophisticated algorithms, and ordinary people all moved in exactly the same direction simultaneously, desperate to escape uncertainty. The tariff shock didn't merely expose market fragility or reveal how interconnected global finance has become. It demonstrated with brutal clarity how deeply America's political uncertainty now shapes financial conditions worldwide. A single announcement from one political leader could trigger tens of billions in losses across every corner of the global economy. And as trading screens glowed red from New York to Tokyo, from London to Sydney, Beijing's continued silence began to look less like indecision and increasingly like a deliberate strategy. Let the panic speak for itself. Let markets reveal the true cost of Washington's volatility. Let investors draw their own conclusions about which government actually understands how to exercise power in the modern world. While Washington remained consumed with debates about how to actually implement and enforce its threatened tariffs, Beijing responded with characteristic precision and restraint. On October 14th, China's Ministry of Transport announced new port fees specifically targeting American vessels, a direct, calculated answer to U.S. policies that had imposed similar charges on Chinese ships. The policy was straightforward, but symbolically powerful. Beginning immediately, any vessel that was owned, operated, built, or flagged by United States interests would pay 400 yuan per net ton when entering Chinese ports, roughly $56 per voyage under current exchange rates. The fee structure wasn't static either. It would gradually escalate year by year, reaching 1,120 yuan per ton, approximately $157, by 2028. On its surface, the measure might seem relatively minor compared to the sweeping tariff threats being thrown around by Washington, but its symbolic importance was unmistakable to anyone paying attention to the deeper dynamics of this conflict. This move targeted the logistics arteries of global trade, the shipping lanes and port networks that move more than 80% of the world's physical goods. By imposing fees that precisely mirrored the American charges, almost dollar for dollar, Beijing sent an unmistakable signal. China would respond to every American action with equal measure, but with discipline and precision rather than rage or improvisation. The policy also exploited a quiet vulnerability in American economic structure. While relatively few ships actually sail under the United States flag due to higher labor costs and regulations, many major international shipping carriers have significant American investment or operate under effective American control through parent companies and financial structures. That means the ripple effects of these port fees could extend far beyond the small number of U.S.-flagged vessels, potentially affecting global shipping costs and insurance markets tied to American economic interests. The announcement itself was delivered without fanfare or theatrical staging. There were no fiery speeches, no government rallies, no heated press conferences. Just an official notice published through normal regulatory channels. Calm, technical, bureaucratic, but sharp. Chinese officials characterized it simply as a necessary countermeasure to Washington's discriminatory port policies. In reality, it represented yet another lesson in how Beijing approaches economic statecraft: respond to every escalation, but do so in ways that cost little politically while delivering strategic pressure economically. Each measure is carefully calibrated. Each response is proportional. Each action creates incremental shifts in the underlying balance of power rather than seeking dramatic confrontations that could spiral out of control. As American markets continued wobbling under the weight of uncertainty and investor fear, China's response projected something entirely different. Quiet confidence. While Washington appeared increasingly reactive and chaotic, Beijing seemed to remain firmly in control of its own strategy, steering a steady course through turbulent waters. The contrast couldn't have been starker. One superpower looked lost at sea, thrashing about without a clear navigation plan. The other appeared to know exactly where it was heading, and how to get there. Beijing's official response to Trump's tariff threats was brief, controlled, and packed with meaning. The Chinese Ministry of Commerce released a statement that carried more strategic weight than hours of press conferences or inflammatory social media posts ever could. The key sentence was simple but powerful. "We do not want a tariff war, but we are not afraid of one." Read that again. It perfectly encapsulates China's entire approach to this confrontation. The message was firm and clear, delivered without emotion or theatricality. It called out the United States decision as an act of unilateralism and economic bullying, accusing Washington of violating the very trade rules and international norms it claims to defend. Chinese officials emphasized their continued preference for dialogue and negotiation over confrontation and escalation. But they made equally clear that any talks would need to happen on equal terms, not with China negotiating from a position of submission or fear. Critically, there was no market panic inside China in response to the American threats. No rush to implement sweeping retaliatory measures that might escalate the situation unpredictably. No signs of the kind of anxious overreaction that often signals weakness or loss of control. Instead, China projected stability, the image of a government that remains in command of the situation, calmly watching while the United States struggled with the market fallout from its own impulsive decisions. At the same time, Chinese diplomats maintained open communication channels through international forums like APEC, carefully avoiding any perception that Beijing was slamming doors or cutting off the possibility of eventual de-escalation. It was a delicate balancing act. Stand firm and demonstrate strength without appearing aggressive or unreasonable in the eyes of the international community. Inside China, the tone taken by state media outlets was notably confident yet restrained. The message repeated across various platforms emphasized that cooperation, rather than confrontation, represents the only realistic path forward for both nations and the global economy as a whole. There were no calls for boycotts of American products, no inflammatory nationalism, no attempts to whip up public anger. For international observers watching from capitals around the world, the contrast between the two approaches was becoming increasingly stark. Washington appeared volatile, driven by domestic political considerations and emotional reactions rather than coherent strategy. Beijing seemed measured and deliberate, carefully calculating each move several steps ahead. In this high-stakes exchange, silence itself became a form of strategy. China didn't need to match Trump's volume or inflammatory rhetoric to demonstrate strength. Instead, by remaining calm and controlled while American markets convulsed, Beijing allowed global investors and policymakers to draw their own conclusions about which side truly held the upper hand.